On December 18th, 2025, the People's Bank of China executed the largest single-day gold purchase in modern history, $4.2 billion in physical bullion. But here's what makes your blood run cold. They didn't buy it through normal channels. They bypassed SWIFT entirely. And in that single transaction, they just proved they can move billions without touching the dollar system. This isn't preparation. This is activation. While you were shopping for Christmas gifts, China flipped a switch on a parallel financial system they've been building in secret for 11 years. A system that processes $12 trillion annually and operates completely outside American oversight. And if you think that number doesn't affect you personally, your mortgage, your 401k, your salary, listen carefully to what I'm about to show you. Because there's a pattern here that's played out 3 times in the last 500 years. Same sequence, same stages, same outcome. The reserve currency dies, and whoever controlled it loses 40-60% of their wealth in under a decade. What's different this time? We can watch it happen in real time. We can see exactly which stage we're in, and we can position accordingly. By the end of this video, you'll understand the exact mechanism China's using, why it's mathematically unstoppable, and what happens to America when the world stops needing dollars. Stay with me, because the next 18 minutes will change how you see every economic headline for the rest of your life. Let me show you something that once you see it, you can't unsee it. Every reserve currency in history follows a 7-stage cycle. Not similar stages, identical stages. The timing varies, but the sequence is absolute. It starts with military dominance that secures trade routes. Then comes currency adoption as the medium of exchange. Next is the debt explosion, borrowing against future trust. Stage 4 is where it gets interesting. Rivals build alternative systems in secret. Stage 5 is activation, what we're seeing right now with China. Stage 6 is the crisis that forces a choice, and Stage 7 is the collapse and wealth transfer. 3 empires, 500 years, same pattern. Let me prove it. Amsterdam, 1602. The Dutch East India Company controlled 50% of global trade. The Dutch guilder was the world's reserve currency. If you wanted to buy spices from Indonesia, silk from China, or cotton from India, you needed guilders. The Netherlands had a population of 1.5 million people controlling the wealth flows of empires 10 times their size. They printed money backed by trade dominance, and the world accepted it because Dutch warships guaranteed the routes. But here's what nobody tells you about empire currencies. The power creates a trap. When you control the reserve currency, you can borrow at rates nobody else gets. The Dutch government bond rate in 1650 was 3.5%, while Spain was paying 14%. Why? Because the world needed guilders, so they bought Dutch bonds. Free money. And the Dutch did what every empire does with free money. They spent it. Infrastructure, wars, tulips. By 1670, Dutch public debt reached 120% of GDP. While that was happening, England was watching. Carefully. The British didn't challenge Dutch military power directly, they built an alternative. The Bank of England, founded 1694, created a new model. Debt backed by future tax revenue and colonial extraction. They established trade relationships that bypassed Amsterdam. Slowly, methodically, they created a parallel financial system. For 50 years, both systems existed simultaneously. Dutch guilders still dominated trade, but British pounds were gaining ground. Then came 1780, the Fourth Anglo-Dutch War. The Dutch Republic, drowning in debt, couldn't finance the conflict. They lost. And in the Treaty of Paris, 1784, everything changed. British pounds became the preferred currency for international trade. Not because of a declaration, because of mathematics. The guilder debt was unsustainable. The pound was backed by growing colonial revenue. Merchants made a rational choice. Within 20 years, Amsterdam ceased being a financial center. The wealth didn't disappear, it transferred to London. Dutch bondholders saw their assets lose 60% of purchasing power between 1780 and 1800. The families that recognized the pattern early. They moved their wealth to British pounds and bought London real estate. The ones who trusted the guilder, destroyed. Stage 1 through 7. Check. Verified. The same pattern played out again, but this time it took 150 years. London, 1815. After defeating Napoleon, Britain controlled 25% of Earth's landmass. The British pound became the undisputed global reserve currency. If you wanted to trade anything internationally, you needed pounds. Britain ran the gold standard. Every major currency was pegged to gold, but denominated in pounds for settlement. The sun never set on British financial dominance. And just like the Dutch, they fell into the trap. British public debt in 1815 was 226% of GDP after the Napoleonic Wars. But here's the trick. When you control the reserve currency, debt doesn't matter the same way. The world needs your currency, so they keep buying your bonds. Britain borrowed continuously. Colonial administration, infrastructure, wars. The Crimean War cost $69.3 million. The Boer War cost $217 million. World War I cost $35 billion. That last number broke them. But while Britain was borrowing, America was building. The Federal Reserve, established in 1913, created a new model, industrial production backing currency value, not colonial extraction. By 1916, U.S. GDP exceeded British GDP for the first time. American banks started offering loans in dollars. Quietly, no formal challenge to the pound, just an alternative that was slowly, systematically gaining adoption. The crisis came in 1944. Bretton Woods. Britain, financially destroyed by World War II, owed the United States $4.3 billion, roughly $75 billion in today's dollars. They couldn't pay. The pound couldn't hold its gold peg. And in the Bretton Woods Agreement, the world made a rational choice. The US dollar became the new global reserve currency, backed by gold at $35 per ounce. Not because of conquest, because of mathematics. The pound debt was unsustainable. The dollar was backed by 50% of global industrial production. British bondholders saw the pound lose 30% of its value against the dollar between 1945 and 1950. Another 40% between 1950 and 1967 when the pound fully floated. The families that moved wealth to dollar assets before 1944, they preserved everything. The ones who trusted the pound, destroyed. 7 stages, identical sequence. But here's where it gets terrifying. We're watching it happen again, and this time we can see every stage in real time. Stage 1, military dominance securing trade routes. America established this after World War II. The U.S. Navy guarantees freedom of navigation in every major shipping lane. Over 750 military bases in 80 countries. This isn't imperialism criticism. This is just describing the mechanism that makes dollar dominance possible. Stage 2, currency adoption as the medium of exchange. Completed by 1971 when Nixon ended gold convertibility. Today, 88% of all international transactions settle in US dollars according to the Bank for International Settlements. If Japan wants to buy oil from Saudi Arabia, they convert yen to dollars, execute the transaction, then Saudi Arabia converts dollars to reals. The dollar is the mandatory middle step in almost all global trade. Stage 3, debt explosion. U.S. national debt. January 2026, $38.5 trillion. That's 122% of GDP. Interest payments just crossed $1 trillion annually. That's more than the defense budget. Medicare spending. It's the second largest budget item after Social Security. And here's the number that should make you nauseous. Debt is growing $6.12 billion per day. Not per month, per day. But remember the pattern. When you control the reserve currency, this debt doesn't kill you immediately. The world needs dollars, so they keep buying treasury bonds. Interest rates stay artificially low because demand is global, not just domestic. This is the trap. This is exactly where the Dutch were in 1670 and Britain was in 1920. Now comes stage 4, the rival building alternative systems in secret. China started construction in 2014. Pay attention to this next part because every piece of information I'm about to give you is from public filings, central bank data, and trade statistics you can verify yourself. The Cross-Border Interbank Payment System, CIPS, launched October 2015 by the People's Bank of China. It's China's alternative to SWIFT, the messaging system that handles international dollar transactions. When CIPS launched, it processed $173 billion in its first year. By 2024, that number reached $12.3 trillion according to the latest data from the China Foreign Exchange Trade System. That's not a backup system. That's a parallel financial infrastructure processing real volume. But CIPS is just the messaging layer. Here's the foundation. China has bilateral currency swap agreements with 41 countries totaling 4 trillion yuan, roughly $550 billion. These agreements allow direct currency exchange without converting to dollars first. Argentina wants to buy manufactured goods from China. They swap pesos for yuan directly, no dollars involved. Russia wants to buy electronics. Rubles to yuan, no dollars. The volume is accelerating. In 2023, China-Russia trade reached $240 billion and 95% of it settled in yuan or rubles according to Russia's central bank data. $0. China-Brazil trade in 2024 exceeded $160 billion, with 60% settling in yuan. The UAE established a yuan clearinghouse in 2024, processing $38 billion in its first 9 months. This is stage 4 behavior, building the alternative while the dominant system still functions. Now watch what happens with gold. The People's Bank of China has been buying gold every single month for 26 consecutive months as of January 2026. Official reserves now stand at 2,264 tons, according to their December disclosure. But here's what makes analysts nervous. China only reports official central bank purchases. They don't report commercial bank purchases, sovereign wealth fund purchases, or purchases by state-owned enterprises. Independent analysts tracking physical gold flows into China estimate actual accumulation between 4,500 and 6,000 tons. For context, the U.S. officially holds 8,153 tons. If the high estimate is accurate, China has accumulated 74% of U.S. gold holdings in under 3 years. Why does this matter? Because gold is the only asset that settles international trade without counterparty risk. If Saudi Arabia accepts yuan for oil, they're trusting the Chinese government. If they accept gold, they're trusting physics. And here's the mechanism China's building. Offer oil producers a choice. Accept dollars and watch America print more, devaluing your payment. Or accept yuan backed by gold convertibility at a fixed rate, preserving your purchasing power. That's not theoretical. That's exactly what's being negotiated right now. In March 2023, Saudi Arabia agreed to accept yuan for oil sales to China. The announcement was quiet. No ceremony, just a technical shift in payment processing. But the implications are seismic. Saudi Arabia sells $50 billion in oil to China annually. If even 30% converts to yuan settlement, that's $15 billion in annual dollar demand disappearing. Multiply that across OPEC. Annual oil sales to China exceed $200 billion. If 50% shifts to yuan over the next 3 years, that's $100 billion in annual dollar demand evaporating. That's $100 billion fewer treasury bonds purchased. That's $100 billion less support for the dollar's value. Same pattern. Same sequence. The crisis hasn't hit yet. We're still in stage 5, activation. China demonstrated the system works. The December 18th gold purchase proved they can move billions outside SWIFT. The yuan-ruble-rial transactions prove the volume is real. But the dollar is still dominant. Treasury bonds still sell. International businesses still use dollars by default. This is the moment between stage 5 and stage 6, the moment where both systems exist simultaneously. Just like guilders and pounds coexisted from 1694 to 1780, just like pounds and dollars coexisted from 1913 to 1944. But here's what history teaches us about this moment. It doesn't last long, and it always ends the same way. A crisis forces a choice. For the Dutch, it was the Fourth Anglo-Dutch War. For Britain, it was World War II debt. The crisis doesn't have to be military. It just has to be expensive enough that the dominant power can't maintain the illusion of stability. Now, I know what you're thinking. But America has the strongest military in history. We're different. We have tech dominance, agricultural surplus, energy independence. We're not the Netherlands or Britain. That's exactly what the British thought. They controlled 25% of Earth's landmass. They had the Royal Navy, the most powerful military force in history at the time. The pound had been reserve currency for over 100 years. Technology didn't save them. Military power didn't save them. Agricultural output didn't save them. Because the problem isn't strength. The problem is mathematics. When your government spending exceeds revenue by 6.5% of GDP annually, America's current deficit, the debt compounds. Interest on debt grows faster than GDP. At current rates, interest payments will consume 100% of tax revenue by 2040, according to Congressional Budget Office projections. Not 100% of the budget, 100% of all tax revenue collected. The only way to prevent that is cut spending by 40%, raise taxes by 60%, or print money and accept inflation. Politically, which one is possible? None of them. So America will do what every empire does, print money and hope the reserve currency status absorbs the inflation. Export it to the rest of the world through dollar debasement. That's the trap. That works until the world has an alternative. Now the world has an alternative. And it's not just China. Look at the capital flows. In 2023, central banks globally bought $70 billion in gold, the highest level since 1950, according to the World Gold Council. Not $70 billion in value appreciation, $70 billion in net new purchases. Poland increased reserves by 130 tons. Singapore increased by 76 tons. India increased by 37 tons. These aren't anti-American political statements. These are rational hedges against dollar devaluation. The smart money is already moving. Ray Dalio's Bridgewater Associates reduced U.S. equity exposure from 67% to 42% between 2022 and 2024, according to their SEC filings. Increased gold in international bonds. BlackRock's latest guidance recommends 15-20% gold allocation, up from their traditional 5%. Warren Buffett's Berkshire Hathaway sold $100 billion in stocks in 2024 and is now holding $334 billion in cash and short-term treasuries, preparing for something. These aren't pessimists. These are the largest capital allocators on Earth, responding to the same pattern you're seeing right now. But here's what nobody's telling you about stage 6. The crisis doesn't need to be catastrophic to trigger the shift. It just needs to be expensive enough that America has to choose between defending the dollar and funding the government. That moment is coming, and the timeline is compressing. Let me show you the 3 scenarios that could trigger stage 6 in the next 24-36 months. Scenario 1, Taiwan crisis. If China moves on Taiwan, America faces a choice. Defend Taiwan militarily, cost estimated at $2 or $4 trillion according to CSIS Wargaming, or accept Chinese regional dominance. If America defends, it requires emergency spending funded by Treasury bond sales. But who buys the bonds? China holds $760 billion in treasuries. Japan holds $1.1 trillion. If they're on opposite sides of a conflict, they're not buying more American debt. They're selling. Interest rates spike. The Fed prints money to buy bonds. Dollar devalues. Crisis. Scenario 2, oil shock. If Saudi Arabia announces 50% of oil sales will accept yuan, dollar demand drops immediately, not gradually. Immediately. Countries that buy oil need fewer dollars for reserves. They sell treasury bonds. Same outcome. Interest rates spike, dollar devalues. Crisis. Scenario 3, debt ceiling standoff. This one's domestic. If Congress deadlocks on the debt ceiling and America actually defaults, even for 24 hours, global bond markets reprice U.S. credit risk permanently. The risk-free rate is no longer risk-free. Every pension, every insurance company, every foreign central bank holding treasuries takes losses. They diversify away from dollars. Same outcome. Any of these scenarios could hit in 2026 or 2027. And here's the acceleration that should terrify you. From the first scenario to stage 7, historically takes 3 to 7 years. The Dutch collapse from war declaration to currency replacement took 4 years. The British collapse from Bretton Woods negotiations to pound devaluation took 3 years. The timeline is compressing because information moves faster now. Capital moves faster now. In 1944, it took weeks to move money internationally. Today, it takes seconds. When the crisis hits, the shift will be faster than any historical precedent. Based on the pattern, here's what happens next. Stage 6. The crisis forces a choice. Could be Taiwan, could be oil, could be debt ceiling. Doesn't matter which trigger. America has to choose between printing money to fund government operations or defending the dollar's value. Politically, there's only one choice. They print. The Fed expands the balance sheet by another $3 to $5 trillion in emergency measures. This is the 6-month window. Immediately, inflation accelerates, not 3 to 4% CPI. Real inflation in food, energy, healthcare hits 12 to 18% as dollar purchasing power drops. Foreign holders of treasuries panic sell. China and Japan dump $500 billion in bonds. Interest rates spike despite Fed intervention. 10-year treasury rates hit 7-8%. Mortgage rates hit 10 to 12%. Housing market freezes. Stock market drops 30 to 40% as cost of capital destroys valuations. This is the 12-month window. The government faces a revenue crisis. Tax receipts don't grow as fast as inflation. Real revenue drops. But spending is locked in. Social Security, Medicare, defense, interest on debt. The deficit explodes to 10-12% of GDP. The Fed prints more. The cycle accelerates. Meanwhile, China offers the alternative: yuan-denominated bonds backed by gold convertibility at a fixed rate. Not to replace dollars immediately, just to offer stability while dollars are chaotic. Countries desperate for functioning currency markets take the offer. Saudi Arabia, UAE, Brazil, Indonesia, Malaysia. Within 24 months, yuan settles 30 to 40% of global oil trade. Within 36 months, it settles 25% of all international trade. The dollar doesn't disappear. It just stops being the mandatory middle step. It becomes one option among several. This is stage 7, the wealth transfer. Dollar-denominated assets lose 40-60% of purchasing power against hard assets and alternative currencies over 5 to 7 years. Not against CPI, against real purchasing power. Your salary stays the same nominally, but everything costs twice as much. Your 401k stays at $500,000, but it buys what $200,000 bought before. Your treasury bonds pay out, but the dollars you receive buy half what they did when you invested. Same pattern, same outcome. So what does this mean for you? You have 2 choices right now. Understand the pattern and position accordingly, or trust the system and hope this time is different. Let me give you the framework the families that survived the guilder collapse and the pound collapse used. First, diversify out of dollar-denominated assets. Not completely, but if 90% of your wealth is in dollars, stocks priced in dollars, bonds paying dollars, and real estate valued in dollars, you have catastrophic single-point failure risk. Target 30-40% of liquid wealth in non-dollar assets. Gold, Bitcoin, international real estate, Swiss francs, Singapore dollars, anything that doesn't depend on the dollar maintaining value. Second, accumulate hard assets before the crisis. The families that bought London real estate before the guilder collapsed preserved wealth. The families that bought New York real estate before the pound collapsed preserved wealth. Hard assets reprice in any currency. A house in Texas, farmland in Iowa, productive real estate that generates cash flow. These maintain value regardless of which currency dominates. Third, understand the timeline. Stage 6 hasn't triggered yet. We're still in stage 5. Both systems work. You can still buy treasury bonds at reasonable rates. Use it. The Dutch had a 50-year window between England launching the alternative and the crisis. We don't have 50 years. We have 24-48 months maximum. Fourth, watch the indicators that signal stage 6 activation. These are your early warning system. China dumping more than $100 billion in treasuries in a single quarter. Saudi Arabia announcing majority yuan acceptance for oil. 10-year treasury rates spiking above 6% despite Fed intervention. Any of these means the crisis is imminent. 30-90 days to position. Fifth, accept that this isn't political, this isn't anti-American, this is mathematics. The pattern doesn't care about military power, cultural influence, or historical momentum. It cares about debt to GDP ratios, currency alternatives, and rational economic decisions by market participants. The guilder collapse wasn't because the Dutch were bad people. The pound collapse wasn't because the British were weak. It's because math is absolute. Sixth, don't panic. Panic creates mistakes. This is a 5 out of 10 year process from activation to completion. Even after stage 6 triggers, you have 12-24 months to reposition. The families that preserved wealth through previous transitions didn't predict the exact date. They just understood the pattern and stayed ahead of it. Seventh, recognize this creates opportunity. The greatest wealth transfers in history aren't just about losses, they're about gains. Somebody benefits when the guilder collapses and the pound rises. Somebody benefits when the pound collapses and the dollar rises. Somebody will benefit when the dollar loses dominance and yuan, gold, and alternatives rise. If you position correctly, you can be on the right side of the largest wealth transfer in human history. The pattern is absolute. 3 empires, 500 years, same sequence, same outcome. We're in stage 5, entering stage 6. The indicators aren't subtle. China just proved they can move billions outside the dollar system. Oil producers are accepting yuan. Central banks are buying gold at the highest rate in 75 years. The debt is compounding faster than growth. The only question is whether you'll see it coming. You have 2 choices. Understand the pattern and position accordingly, or trust the system and hope this time is different. But remember, this time is never different. The pattern doesn't need your belief. It doesn't wait for permission. It just unfolds. Tell me in the comments, where do you think we are in this cycle? What are you seeing in markets, in trade, in geopolitics that confirms or contradicts this pattern? I want to hear your analysis. Subscribe because the next video reveals the 3 specific indicators that will tell you exactly when we are moving from stage 5 to stage 6. And I'll show you the exact asset allocation that outperformed everything else during the guilder collapse, the pound collapse, and the early dollar era. The families that preserved wealth through these transitions used a specific formula. I'll break it down step by step. You cannot miss this. The pattern doesn't need your belief. It just unfolds. Thanks for watching.